All right, so you want to learn how to read the markets like a pro, huh? Well, you've handed us the rule book, John J. Murphy's Technical Analysis of the Futures Markets, and we're diving deep. Charts, trends, signals, we're going to cover it all so you can really get a grip on technical analysis.
And while the book zooms in on futures, don't forget those core concepts. They apply to any market where price action spins a good yarn.
Exactly. No matter what you're trading, price tells a story. So how do we start with the big picture? What exactly are we talking about when we say technical analysis?
Well, it's a bit like being a detective at, say, a crime scene. But instead of dusting for fingerprints, we're looking at the market's footprints, those price movements, the volume of trades, heck, even the number of active contracts, open interest, as it's called.
So instead of digging into the why behind the market moves, like those fundamental analysts always do,
Technical analysts are all about the what. They live by the motto, actions speak louder than words, kind of like the strong, silent type of the market world. They believe the market's movements are where it's at, more telling than any flashy headline or earnings report.
so less about dissecting a company's finances and more about understanding what the stock chart is trying to tell us.
You got it. Think of it this way. You walk into a room packed with people, you instantly pick up on the vibe, right? Excited, anxious, bored out of their minds. You get a feel for the general mood without needing everyone to spill their life story. Technical analysis is like that. It's all about reading the room, getting a sense of the market's mood through its price action.
Love that analogy.
Yeah.
But I got to ask, how do we avoid seeing what we want to see in those charts? Like finding shapes in clouds, letting our imaginations run wild.
That's where a healthy dose of skepticism comes in handy. Even Murphy admits technical analysis isn't some kind of magic bullet. One big criticism is this whole self-fulfilling prophecy thing. Like, if a bunch of traders see the same chart patterns and act on them, well, they might just end up pushing the market in that direction anyway, regardless of what's really going on behind the scenes.
So it's like everybody's looking at the same navigation app and suddenly, boom, traffic jam on a road that's usually deserted.
You nailed it. And then there's the big question. Can we really trust past data to predict what's going to happen in the future? I mean, markets are like wild animals, unpredictable, constantly changing. Throw in a random event, and even the prettiest chart goes out the window.
And we can't forget about that random walk theory. That whole idea the prices are just bouncing around randomly, no rhyme or reason. If that's true, then what's the point of searching for patterns anyway? Seems like a fool's errand.
Murphy tackles that head on. He gets that the random walk theory might hold some water, especially in those super efficient markets. But he makes a strong case that most markets, especially futures, they're swayed by those psychological biases, those trends that technical analysis can help us spot and hopefully capitalize on.
So it's not about blindly following charts like some kind of robot. We got to use our brains, understand the limitations, and expect the unexpected.
100%. Think of it as a tool, not a crystal ball. But, and this is key, a powerful tool. It's like having a compass and a map to navigate the crazy, often wild world of the financial markets.
Okay, so we're ditching the crystal ball idea, but what about those actual tools Murphy talks about? He mentioned something called Dow theory. Ring any bells?
Oh, it's fundamental. And no pun intended, right? Given how we usually see technical and fundamental analysis as two different beasts. Charles Dow, the guy behind the Dow Jones Industrial Average, he laid out these principles way back in the late 1800s.
Talk about vintage.
But get this, they still hold up today. Why? Because they capture those timeless truths about how markets work. It's like they're etched in stone.
Feels like we should be taking notes with quill pens and parchment paper, huh?
We'll stick with our laptops for now. But yeah, the first principle, the averages discount everything. Pretty bold statement about market efficiency. It basically means the current price already factors in everything known about a stock or a market. Yep. All the news, good or bad, rumors, hopes, fears, you name it, it's all baked in.
So no point in trying to outsmart the market by jumping on the latest headline.
Exactly. Dow, he believed that if a piece of news was really a big deal, it would already be reflected in the price. He wasn't into chasing those little blips. He was all about identifying the underlying trend, the big picture.
Which brings us to another key tenet confirmation. Didn't Dow say a real market trend should show up in multiple averages?
You're catching on. So if the Dow Jones Industrial Average is going up, but the transportation average, which reflects economic activity, if that's lagging behind, that's a red flag.
Like a warning sign on a stock chart, right?
Right. It's like checking all the gauges on a plane, making sure they're telling you the same story. You know you've got real strength when different sectors of the market are all moving in sync.
Like a flock of birds, all heading in the same direction. Okay, so say we've got a handle on the overall market trend, but what about those individual stocks, those futures contracts? That's where support and resistance come into play, yeah.
Bingo. Imagine a battlefield, but instead of armies, it's bulls and bears fighting it out. Support is that line in the sand where buyers tend to step in, stopping those declines in their tracks.
A safety net of sorts.
Kind of, yeah. And resistance is like a ceiling, a point where selling pressure kicks in, putting a lid on those advances.
So are those levels based on anything concrete, or are they more psychological?
It's a bit of both, really. Murphy says these levels, they're often psychological. Traders, they remember what happened at those prices in the past, and they react accordingly.
Got it. So past performance can mess with future results.
You could say that. Imagine a stock that's been struggling to break through $50 for months. Traders, they see $50 and they get all hesitant. Some might even start selling, thinking, here we go again.
Because they anticipate that resistance to hold strong.
Exactly. And on the flip side, if a stock keeps bouncing off support at, say, $40 buyers, they might feel more confident snapping up shares around that level, figuring history is going to repeat itself.
So it's all about identifying those key levels, the ones that really matter.
You got it. And those aren't just random lines we're drawing. Look at the trading volume. When was the last time the price really battled it out at that level? Even those round numbers like $10, $100, those can all give you clues.
Like a treasure map. All right, let's connect those dots literally and talk about trend lines.
Ah, trend lines. Simple, yet oh so powerful. You're basically connecting those rising lows in an uptrend or those falling highs in a downtrend.
It's like those connected dots puzzles, right? Suddenly you see the bigger picture emerging.
Exactly. But here's the cool part. Trend lines, they're not just for show. They also act as potential support or resistance themselves.
Wait, really? So if a stock is trending upwards, then takes a little dip down to its trend line, that could be a buy signal.
It could be. Traders might see that as a buying opportunity, betting on that trend line to hold strong.
And if it breaks below that trend line with a ton of volume,
Whoa, that could be a sign of trouble. Momentum might be shifting, could even be the start of a downtrend. Talk about a visual clue.
Murphy also talks about breakouts. That's when prices power through those resistance levels or crash below those support levels, right?
It's like the market's breaking free. And those breakouts, those can be powerful signals, especially when you've got a surge in volume to back it up.
Like a confirmation signal.
Exactly. But gotta watch out for those false breakouts. Murphy calls them fakeouts. That's when prices tease you, they poke through those levels, then bam, they reverse course, leaving traders who bought in too early out in the cold.
Ouch. Expensive lesson to learn.
Tell me about it. Patience, my friend. That's the name of the game. Another little nugget Murphy throws in about trend lines. He's got this measuring technique. He says once a trend line's broken, prices often move a distance beyond that trend line equal to the vertical distance they achieved on the other side of the line before reversing.
Hold on, so it's like having a ruler built right into our charts. That's seriously useful.
Right. It shows you those trend lines are more than just lines on a chart. They're powerful tools for understanding how the market really works. Now, ready to move beyond those basic trend lines, let's talk about something a little more eye-catching, major reversal patterns.
Bring on the aha moments.
These patterns, they hint at a potential shift in direction, like from uptrend to downtrend or vice versa. Like the market is making a U-turn.
Got it, a U-turn on the price charts.
And just like those U-turns in real life, these patterns, they can mean big changes are coming. One of the most famous reversal patterns is the head and shoulders. Picture a mountain range with 3 peaks. The middle peak, that's the head. The 2 outer peaks, those are the shoulders, roughly the same height.
And then you connect the lows between those peaks, creating something called a neckline.
Right. You're on fire today. And get this, a break below that neckline, especially if it happens with heavy volume, that's a classic sell signal.
Like everyone's rushing for the exit.
You got it. And volume, that's crucial for knowing if those patterns are the real deal. Murphy says it takes more oomph to push prices up than it does to drag them down. So when you see heavy volume on that downside breakout, it's a pretty strong sign those sellers are in control.
Like a snowball gaining speed as it rolls downhill. Okay, what about those times when the market needs a breather, pauses for a bit before continuing on its merry way?
Continuation patterns, right?
You're reading my mind. Think of these patterns like pit stops on a road trip, just a quick break before the journey continues.
Got it. So how can we tell if we're looking at a continuation pattern or a potential reversal? They both involve a pause in the action. That's where our old friend, volume analysis, comes in handy again. With those continuation patterns, volume usually drops as the pattern takes shape, then surges again on the breakout, confirming the trend's back on track.
So it's like the market taking a deep breath before making its next big move.
Perfect analogy. Now, we've talked a lot about price patterns, but Murphy's big on going beyond just the price. He calls volume and open interest the market's whisperers because they reveal the true story behind those market moves.
Like listening in on the market's secrets.
He's spot on. Volume analysis can be super insightful. For example, you see heavy volume at the bottom of a downtrend, and it's paired with a bullish reversal pattern. Well, that's a powerful signal.
Bullish meaning things are about to turn around.
Yeah, it means buyers are piling in, and those sellers might be throwing in the towel.
Makes sense. Now, what about open interest? That one sounds a bit more complicated.
It's not too bad. Open interest tracks the total number of outstanding contracts in the futures market. And it gives us another piece of the puzzle, like if open interest is going up during an uptrend, that's generally a good sign, means new money's flowing into the market. But if it's declining during an uptrend, that could be a warning sign.
A warning sign of what exactly?
Could mean the rally's running out of steam, maybe it's being fueled by short covering rather than fresh buying.
So open interest, it's like checking the market's fuel gauge? See how much gas is left in the tank.
Love it. And just like a packed party can turn chaotic in a hurry, Murphy points out that sky-high open interest at market tops. That can be a sign to watch out.
Because if everyone decides to bail at the same time, watch out below. Okay, before we move on to those even fancier tools you mentioned.
You thinking about moving averages and oscillators?
Oh, yeah. But first, let's take a step back. Look at the big picture with those long-term charts.
Music to my ears. Murphy, he's all about long-term trend analysis. He argues that those major trend changes, they don't happen overnight, they take time to develop. And those longer-term charts, like weekly or monthly charts, they help us tune out that short-term noise, those little distractions.
Like the difference between looking at a map of your neighborhood versus a map of the entire country.
Exactly, you want the lay of the land. Long-term charts, they're like having a bird's eye view of the market. They show you the major trends that really matter, the ones driving those market moves over months, even years.
The big picture trends.
You got it. And those long-term charts, they can be super valuable for spotting those major support and resistance levels, the ones you might miss if you're only looking at those short-term charts.
So we've covered a ton of ground here. Those foundational principles of Dow theory, the importance of support and resistance, those trend lines, volume analysis.
We've even dipped our toes into those chart patterns and stressed the importance of taking a long-term view.
But, and I know this is asking a lot, my brain is officially craving more. Especially those sophisticated tools you mentioned, things like moving averages, oscillators. Even Elliott wave theory has a nice ring to it. Sound intriguing and intimidating all at the same time.
Don't worry, we'll unpack those tools, make them crystal clear. But for now, let's take a breath. Let all this goodness sink in. It's a lot to process, I know.
A quick pause. Sounds good to me. My brain needs to recharge before we dive back into that fascinating world of technical analysis. All right, time to fire up those sophisticated tools we put on pause. Let's talk moving averages. Those always seemed a bit mysterious to me.
Not as complicated as you might think. Imagine you're on a road trip. Instead of focusing on every little bump in the road, you want to see the overall direction, the flow of the journey. That's what moving averages do for us on a price chart.
Got it. Instead of getting hung up on every little price swing, moving averages help us see the bigger trend.
Exactly. The simplest kind is called a simple moving average. Basically, it averages a certain number of closing prices over a specific period, say a 10-day simple moving average. That would average the closing prices from the past 10 days.
So it's like looking at a moving snapshot of the price action.
Exactly. Each day, a new price gets added to the mix, and the oldest one drops off. Keeps the average, well, moving.
Okay, that makes sense. Now, I've also heard of exponential moving averages. Are those similar?
They are, but with a twist. Exponential moving averages give more weight to the most recent prices, so they're a bit more sensitive, quicker to react if the market makes a sudden move.
So it's like having a more responsive steering wheel. You can react to those sharp turns in the road more quickly.
Perfect analogy. Now here's where it gets really interesting. Traders use these moving averages to spot potential trading signals. Ever see those charts with multiple lines crisscrossing?
Oh yeah, all the time.
A lot of times, those are moving averages with different time frames, say a 10-day and a 40-day moving average. When that shorter-term average crosses above the longer-term average, that's often seen as a bullish signal, like a green light saying, hey, momentum might be shifting to the upside.
And if it crosses below, That would be...
Bearish. Like those caution signs on a winding road, those crossovers can give us a heads up about potential trend changes.
Love that. Okay, now for something that sounds a bit more mysterious, Bollinger Bands. What's the deal with those?
They're not as intimidating as they sound, promise. Think of a moving average again, but this time imagine a band of space above and below it, sort of like a river flowing between its banks. Those are your Bollinger Bands.
So the width of the bands, it changes depending on how much the price is jumping around.
You're getting it. It's all based on something called standard deviation, which basically measures how volatile, how spread out those prices are. When volatility is high, the bands widen, giving the river more room to flow. When things calm down, the bands contract.
So it's like the market has its own built-in speedometer.
Exactly. Traders watch how prices interact with those bands. If the price breaks above the upper band, could be a sign of a breakout to the upside. Breaks below the lower band, could mean a breakdown to the downside.
The market's testing the boundaries, seeing if it can break free. Okay, those Bollinger Bands are pretty cool. Now let's talk about those oscillators you mentioned. They're supposed to help us measure those market extremes, right?
Right on. Imagine a swing set going back and forth. Oscillators are like having a gauge that tells you when the swing might be getting ready to change direction.
So they're like those little warning signs at the playground, reminding us that what goes up must come down.
Perfect analogy. One of the most popular oscillators is called the Relative Strength Index, or RSI. It looks at the size of those recent price changes to figure out if the market might be getting overbought or oversold.
Overbought meaning due for a pullback, and oversold meaning it might be time for a bounce.
Exactly. But, and this is important, oscillators are just one piece of the puzzle. Another popular one is called stochastics. It uses two lines that move between 0 and 100.
So it's like having two thermometers, each measuring a different aspect of the market's temperature.
You've got it. Traders look for crossovers between those lines, as well as how they're lining up with the actual price action. Gives them clues about potential trading opportunities.
Got it. And I can't forget about MACD.
Ugh. The moving average converge and divergence. It sounds super complicated.
It does, but it's just a way to measure momentum, right?
You got it. It's all about the relationship between those moving averages. Traders use it to spot changes in trend strength and those potential overbought and oversold conditions. Now, you ready to dive into the deep end? It's time for Elliott wave theory.
All right, hit me with it.
Buckle up. This one's a brain twister. Elliott wave theory, developed by this guy named Ralph Nelson Elliott back in the 1930s, it's based on the idea that those market movements, not random at all, they actually follow these predictable wave patterns.
So the market's not just making it up as it goes along. There's a method to the madness.
That's what Elliott believed. He identified these 5-wave impulse patterns that move with the main trend, and then these 3-wave corrective patterns that go against it. And get this, these waves, they're nested within even larger waves, creating this really intricate structure.
Now, where do those famous Fibonacci numbers fit into all of this?
Those Fibonacci ratios, they pop up everywhere in nature. And Elliott wave analysts use them to estimate things like potential retracement levels, price targets, how long a wave might last. It's all about those proportions, those ratios.
Okay, that is a lot to wrap my head around. Elliott wave theory definitely deserves its own deep dive someday. But in the meantime, let's come back to Earth for a minute and talk about time cycles.
Sounds good. Just like nature has its rhythms, the seasons, the tides, so do markets. These cycles can be short-term, like within a single trading day, or they can last for years.
So it's like the market's dancing to a beat, but we don't always know the tune.
You got it. But by studying those rhythms, by understanding those cycles, we can get better at anticipating those turning points, those shifts in the market's mood.
Like predicting the tides. Okay, one last thing before we wrap up. You mentioned computerized trading systems. What role do those play in all of this?
In today's world, technology's everywhere, and the markets are no exception. Computerized trading systems, they use algorithms, basically pre-programmed rules, to analyze all that market data, spot those trading opportunities, and even execute those trades automatically.
So it's like having a trading robot working for you 24/7.
In a way, yes. And because they're computers, they can process tons of data super fast, way faster than any human could. Plus, they don't get emotional, which is a huge advantage when the markets get crazy.
So they take the fear and greed out of trading.
Exactly. But, and this is key, even the smartest algorithms, They're only as good as the rules they're programmed to follow.
So that's why understanding technical analysis is still so important.
You got it. It's all connected. The best traders out there, they use a blend of their own knowledge, their experience, and those powerful computerized tools. It's man and machine working together.
Just like Murphy intended. You know, this deep dive into his book has been amazing. We've gone from those basic price charts to decoding the language of the market with patterns, indicators, even a little bit of natural mathematics with those Fibonacci ratios.
It's been quite a journey, and if there's one big takeaway, it's that technical analysis. It's not about predicting the future with absolute certainty.
It's about understanding those probabilities, about managing that risk, about making those smart decisions based on what the market is telling us.
Exactly. And never stop learning. The markets are always evolving, and so should we.
Well said. To everyone listening, keep exploring, keep learning, and most importantly, keep charting your own course through the amazing world of technical analysis.
Happy trading, everyone!